Meanwhile, shipping rates skyrocketing amid ongoing attacks against commercial ships in the Red Sea, rising 23% in a single week as of January 18th. Thus far, U.S. airstrikes have not stopped Houthi forces in the region. What do these disruptions mean for consumers and prices? We're joined now by Stephen Schwartz, Wells Fargo Global Receivables Trade Finance EVP, the Supply Chain and Global Trade Division of Wells Fargo. Stephen, it's good to see you. So the attacks continue, Stephen. The disruptions continue. We've seen this increase in shipping costs for companies, Stephen. Can you help us just kind of quantify that increase in shipping costs? Is it near now, Stephen, the rise we saw during COVID?
Well, first off, thank you so much for having me today. The disruption in the Red Sea is leading to longer delivery times as a large percentage of the ships are continuing to avoid the region, which is certainly having an impact on global capacity. And it's really that impact on global capacity which is impacting shipping costs, which have certainly spiked in the last 2 months, but they're really not anywhere near the levels that we saw at the height of the pandemic. So today we have seen impact really hitting Europe, mostly around supply chain disruptions, but it also impacts China as well, given their export-reliant economy. But we haven't seen material impact in the U.S. to date.
And do you think that we will start to, Stephen? I mean, it seems to me this has already gone on a little bit longer than some analysts might have predicted here, or has been more severe. And so at what point, what's sort of the tipping point where we could start to see these higher costs as a result of this maybe spill over into higher costs for consumers or the wholesalers who are buying this stuff?
Yeah, I think it's a really good question, but it's also a very complicated question. And it's not just about shipping costs. So with the help of our Wells Fargo economists, we look at a lot of data, especially around consumer demand, like inventory levels, port activity, timeliness and completeness of deliveries, in addition to key labor statistics and more. So while we have not seen the disruption in the Red Sea lead to material impact in U.S. consumers to U.S. consumers today, right, we're continuing to monitor the situation closely. And certainly the risk of impact increases the longer the disruption continues.
Are there certain sectors, industries, Stephen, that are more at risk to these disruptions than others?
Not particularly. It's with the way that supply chains work today, it's truly a global supply chain world that we live in. And so it has there's a trickle down effect, and it really has the impact to hit all companies.
And so what is sort of the next thing to watch in this evolving situation here, Stephen? It seems like we're sort of going sideways, for lack of a better word. It doesn't seem like things are escalating more at this point, but it's sort of a bad situation just persisting.
Yeah, look, we're going to continue to watch the economic data as it comes out. We're going to continue to watch the geopolitical tension across the globe. And again, it's a complicated set of factors that can impact inflation coming from supply chain disruptions. And so at the moment, we're at a wait and see approach. But again, as we've seen, that can change very quickly.
And Stephen, for companies who are dealing with this, any guidance or thoughts about how they should be responding? Should they be focusing, for example, on what they should be expediting? Should they be, building up inventories by 10 or 20%?
Yeah, I would say two things really have come to mind. So we already saw a big shift coming out of the pandemic as companies started to move away from just-in-time inventory. And they've really focused in on inventory timing and decisions that they need to make, especially around seasonally important inventory, where if you miss those windows, it could really have a lasting impact. Right. And they've also worked, another thing that's really come out of the pandemic is that they've worked to diversify their supplier base. I would definitely see those two trends continuing.
And Stephen, since you do the financing for some of these companies, sort of what's the backdrop for that right now? How stretched are companies? Do they need to, especially with an environment where it looks like rates are starting to come down, are things sort of loosening up? In other words, they have sort of more flexibility now than they did, say, a year ago.
I would say they not only have more flexibility, but we've definitely seen companies take a more proactive approach to maintaining inventory levels. And so I think that's one of the reasons why you haven't seen as dramatic of an impact in the US, because companies are in a better spot today than they were at the height of the pandemic.
Stephen, thanks so much for joining the show today. Really appreciate that time and insight on this issue, and we'll keep watching. Thank you.
Thank you both so much.